Today, I'm joined by Neil O'Donnell and Mehak Rashid, the managing partners at LegalScale LLP, a boutique law firm that specializes in venture debt, fund formation, and private equity transactions. Thank you both for being on today.
Happy to be here. This is great,
Yeah,
Danny.
thanks for having us.
Absolutely. Well, let's just get right into it. Neil, why don't I ask you to tell a little bit about launching your first fund? So when someone, let's say they're launching maybe a middle market private equity fund, maybe a venture capital fund, first time fund launch, can you tell us about the typical structure of sort of entities and what are the basic blocking and tackling that you're going to have to help them from the legal side to get started?
100%. And so, this question comes up a lot, and thankfully has come up a lot for us since our inception, but with an increasing amount in the last 2 years. I think for each dynamic asset manager, they often are very entrepreneurial. They've typically worked on a fund platform in the past, sometimes a very, very big fund platform, sometimes something much smaller, but maybe they've done two or three funds on a deals team, and now they're looking to start their own fund platform or their own investment manager. What we say first and foremost is we should absolutely consider, are we going deal by deal or are we adopting a discretionary fund at the outset? That's really a key item to consider. And both have their advantages and disadvantages. For a fund that is discretionary, it can be great to be able to do 5, 10 deals and be able to have a diversified portfolio from the outset. On the flip side, sometimes investment managers are looking to raise capital for just a single deal. Sometimes they have capacity to invest in Anthropic or another quickly burgeoning space, and they think will be easier to raise capital just for that deal. And so that's one of the questions that we encourage them to think about from the outset, because even if they just have one deal, but they have committed capital for similar investments going forward, maybe it's time to start a discretionary fund. Conversely, it could also be time just to focus on the one SPV. Once we make that key determination, we then have a list of 10 to 15 questions that team should consider. Those include, what does the total team look like in order to manage this fund? Is it going to be just you, and you'll need a broader suite of service providers? Or over the life of the fund, are you looking to bring in other team members that would bring administration and other things in the house? Last, we want to think about things like a waterfall. Do we have anchor investors that want special terms, or is it a relatively diversified LP pool that we don't really need a lot of side letters and other terms for? And then last thing, but one of the most important, is of course tax. So we go through tax and the tax analysis. The tax situation is getting more challenging and is harder than when I started my career. The Tax Cuts and Jobs Act of 2017, and that's been increased by the One Big Beautiful Bill, those have increased the tax complexity, especially around the deductions for certain types of expenses. And so we go through that entire framework and we work with the investors to make sure that they understand that, and there are no surprises later. So that's kind of what we do each time. I would say that maybe takes place through 2 or 3 30-minute conversations. And then from there, the deliverable is a statement of terms to the investors, a 2 or 3 page document so they can hit the ground running and start to soft circle LPs.
Got it. I want to ask a follow up on some of that. So you mentioned, or you alluded to sort of, well, you didn't say this, but like talk about for an early fund, maybe it's a fund one and there's a lot of friends or family investors. Maybe there's some larger LP interest, but what are the different how do you advise clients of like the incentives? And this is frankly coming from a curiosity question and conversations I've had where I guess from one perspective, I can imagine large institutional established fund managers have sort of tiering of incentives. There's buckets of investors and there's very formal legal negotiations of rights that they want to negotiate for, discounted fees potentially. There's a whole world of established institutional. What does that conversation look like for an emerging manager who comes to you and says, hey, we're raising our fund. We've got this pool of investors. Like they've got a decent track record and they have good momentum. So confidence that they're going to raise. How do you steer them to like, hey, stay simple versus, okay, if you need to provide incentives to your investors, like look in this shelf of like simplified options? What is that?
That's such a great question. And it's one that is very important and very timely, because I think that there is an increasing amount of complexity as well, and maybe needless complexity in the system. But just like you said, Danny, the fundamental advice is keep it simple, and as importantly, keep it consistent. And so, and what I mean by that is, of course, simple and maybe more standard is a 2 and 20 framework, and that could be lower on the debt side depending on the nature of the platform. But tiering incentives and maybe tiering around IRRs, especially, can be very complicated. The reason I bring up IRR specifically is not only is that a performance metric, but one that embeds a time element to it, right? An internal rate of return inherently embeds time. Conversely, if you had a MOIC, a multiple on invested capital versus an IRR, that's still a return hurdle. And so we would still want to make sure that we understand with the investor exactly how that tiering works. But then a 3x MOIC is a lot easier for us to understand and is going to be clearer and more patent that the investors have reached versus a IRR, because then a 3x return over 5 years has a very different IRR than one over three. And sometimes investors just want to see the basic level of a fund return versus have any time component. And so simplicity has really a couple of different flavors. One, simplicity is, and consistency, like I mentioned before, is maintaining the same terms across investors. What sometimes investors will push for is a management fee that's tied to committed capital versus capital deployed versus invested capital. Those are three different bases. And so if you have all three of those when you're calculating your management fee, your ops guy will drive over to 2 Park Ave and he'll punch me in the face. When we've seen that, it's something that, like, we're trying to enter into deals, we're trying to get large investors into the pipeline. We always advise investors to keep things consistent, especially across a fee base. It's a lot easier to negotiate 50 basis points off a management fee than work off of a different fee base. And that adds a lot of complexity versus keeping things consistent and keeping things simple. Second, like I said, making sure it's readily observable. Knowing that what a 3x return looks like, that's probably easier than knowing what your IRRs are going to be and exactly when people plan to sell. And then last, I would just say and like you said, try to align incentives. So there's a multiple number of shared wins that can happen. And one item that we see a lot, and that's happening quite a bit, is a request for physical distributions or physical returns. So if we have stock, that's a physical return of the stock. If we have Bitcoin or some other crypto assets, it's the distribution of that Bitcoin or crypto assets. That can be increasingly important now to establish a holding period. And there's often very good alignment for investors to have that, as well as the investment manager to have that. So in addition to simplicity and consistency, we want to basically say, like, hey, look, to the extent that you want to receive these physical distributions of return for the investor pool, that's great. And an easy give then for the manager to ask for is to satisfy their own promote with that return as well. And there's tax reasons why that can be very helpful.
Awesome. That's a great answer. And Mehak, I'm coming to you with different sort of venture debt based question, but anything else to add to sort of the points we just went through with Neil?
I mean, Neil definitely hit the nail on the head. The idea is really for us to figure out exactly what flavor of type of fund any new client is looking for. So whether that's, a single asset SPV or a full flagship fund, those things have very different dynamics and things to negotiate, along with the number of investors that might be backing them, whether it's, a couple family friends, like you mentioned, Danny, or if it's a larger syndication. So those things are certainly ideas that need to be set out front so that we can properly navigate. And that comes along with just the idea of what the fund will look like, let's say, a few years down the line.
So shifting gears a little bit, read a lot more about venture debt. We hear about more about venture debt. I know you guys do deal with this a little bit. Mehak, could you just tell us a little bit of, what is venture debt? When is it commonly used? What or maybe some of the differences between venture debt and equity? I guess we'll start there as an overview.
Yeah, absolutely. So a lot of companies, when they get started, they are looking for equity investments, and that's what they're able to get in the door first. But then what venture debt does is it's like a runway extension, but it has strings attached to it. So you are able to get more out of what the equity dollars that you already got and expand that further to continue to grow the business. But like I said, it doesn't come without strings. So you do have to understand what kind of covenants is your business going to be need to comply with. So for example, before with equity, you just had to, give reporting to your investors, keep them apprised of what's going on. But now all of a sudden, your business can't do XYZ. It can't take on additional debt. It needs to provide financial statements. It needs to comply with financial covenants in order to keep the debt itself out of default. So having said that, it's also wonderful for the business. As a debt attorney who doesn't like taking on debt myself, I have to say that this is one of the ways that it really rockets growth for companies as they get their first facility which may look more like a venture debt facility. And then as they grow, where they get larger facilities that may be, let's say, first lien, second lien structures or mezzanine pieces or an asset-based lending facility as well. In order to unlock that second tranche, you really have to have that venture debt facility first. It's always a race of who's going to be first to be second. So these larger lenders are always trying to come in knowing that other lenders have vetted a company and underwritten them.
Got it.
Yeah.
Could you give an example of like, think of like some, without naming names, like a success story of like a scenario where, you came across company XYZ, it was a venture backed company growing for various reasons. They went the venture debt route and they've sort of gone on to their next, I guess, next capitalization. Could you just give like an example of a firm or a story?
Yeah, absolutely. So this is fresh off of my mind since we closed this transaction just last week. But this company we've been working with since the very beginning. They helped their equity round, and we were able to get a very large equity piece, which acted like the equity backstop to our initial debt facility that we did with them. So, what I mean by that is often when there is a debt facility in place, sometimes you won't get, let's say you're funding receivables. You won't get 100% of the receivable amount in order to fund it. We always call this an equity haircut, where let's say your advance rate is 85%. And so that 15% is your skin in the game that needs to be put up by the company itself, whereas the lender gives you 85. So that together creates 100% of that receivable. So that's why the equity portion is really important to have even prior to entering into this debt facility. So we were able to get them a smaller debt facility. They unlocked more and more as the value of the receivables increased and their generation and origination of the receivables increased as well. And then just recently, we not only increased the main senior facility, but we were able to put in a mezz facility on top and in between the parent company, the original SPV that was financed by the senior facility, and we dropped in a mezz piece in between. And now they went from, let's say, a 15% equity haircut. Now that Mez piece is supplying 10%. And so now they only need a 5% in order to meet the full 100. And that's how they were able to leverage the, pun intended, the debt facilities in order to unlock even more and more originations and funding and the growth of their business.
And are these conversations generally brought to you by the founders of the firms, or do GPs bring up these conversations? Maybe it's a combination of both. I guess I'm just trying to think of like, what are the considerations that ultimately lead them to make this decision to go the venture debt route?
It's a great
I think,
question.
go
You
ahead,
go
Neil.
first.
Either, yeah.
Yeah, I'll jump in and then Neil, please add. But the idea is really looking at forecasting of your cash flows, right? To understand how is the business going to work. For example, the one that I'm talking about is like a insure tech company, and so there's a lot of outflows of cash in December, January, and so we need to forecast that appropriately. Whereas other companies that I work with might have a more regular season, not cyclical. Again, forecasting that need and understanding exactly when will you need the cash, how will you be able to deploy it really matters into when you start negotiating these facilities. Because they, unfortunately, I wish they could be done overnight, but they certainly take a lot of time to properly structure and put in place and negotiate. But Neil, please feel free to add anything to that too.
I think that's exactly right. I mean, I would say for this to the point as well, what Mehak and I really try to do, and by virtue of being both business and legal minded as entrepreneurs and with JD MBAs, I would say we're also talking to the entrepreneurs about what we've seen other companies do. So the company that Mehak just spoke to, for example, is an insurtech company, and they've known because of an increasing demand for one specific product type that they wanted this additional mezzanine layer in order to be able to scale a product to the full size that they could. And otherwise, cash constraints would have been a limitation on offering the product throughout the 2025 cycle. So Mehak and I had multiple conversations with the CEO and COO, who are both A+ people. And we're thinking about them right now because they're based in Minneapolis. And so we're very much attuned to their needs. And after we did the Series A extend round, we immediately started talking to him about this mezzanine facility. We wanted him to get that in place in the right time of the cycle. And bearing in mind, too, that we already had the senior debt facility, just like Mehak spoke to. And so we started those conversations early, which is always better, so that nobody feels blindsided and we knew exactly the feature set that we were looking for. Then Mehak came up with a plan that was operated on the business side. And I took a final look before we presented that to the board because I'm the secretary for the company and at every board meeting. And now that Mehak has landed the plane in terms of a very excellent mezzanine facility, at this point now we can actually start on a second round for this company as well and bring in more equity dollars, leveraging all of Mehak's excellent work. So we just want that flywheel to really turn faster. And each of these facilities and each of these equity financings support one another in a way that's really complementary, so long as the core businesses work.
Yeah, that's great. No, that makes a ton of sense. I think it's a growing space. There's probably more need for it than there is capital, which we'll get to in a second. Last thing, just a sort of an in the weeds question. Can you give a few examples of like covenants and warrants and like terms? Like how can people think of like when one of these are in places, what are some of the core pillars that they're structured around?
Yeah, that's a great question. What lenders, especially when they come in at the early stage of a company, want to see is cash. They want to see that companies can actually support, literally put their money where their mouth is. And so they often will include minimum liquidity tests. So that would be at the opco level of, let's say we have a parent company on top and then an SPV where we have the financing going in. They want that minimum liquidity test at the opco at the parent level. There may also be cash runway ratios, which are similar ideas, but they're whereas a liquidity test is, let's say, a slice in time, a cash runway ratio is an ongoing future forecasted test. So they might want to see that you have at least 6 months of cash burn at any given time. And then there are always specific tests that might be related to the underlying collateral. So in my earlier example, let's say that there are receivables. There may be a default scenario where often I'll see two different types when one might be what's called a stop funding event and the second might be an event of default, meaning let's say that your default ratio where you have receivables ends up where it's like 15% of it is defaulted. At that point, maybe it's okay, you're not going to get any more cash from the lender, but we're either not going to put you in default or we might start amortizing the loan. And then the second one, which is a higher threshold, would be pure event of default. So those are things that we would encourage borrowers to look at and model out at the term sheet stage to understand exactly what their business looks like and what, let's say, their default scenario looks like and what their liquidity looks like so that they can properly negotiate this even before signing a term sheet.
Then maybe last question on this section is from my understanding, SVB was the leading venture debt lender pre the SVB collapse. How has that changed? I imagine, and I even see there's a lot more banks that are in this space. I'm sure there's a lot of different private lenders. I guess could you just opine a little bit of like what does the market look like that's a little bit different? What's better? Maybe what's worse? It seems like it's definitely grown both in demand of companies that sort of are a good fit for this. And I guess there's definitely more companies coming to supply it. So what has changed over the last few years?
Yeah, I think over the last few years, there's been a lot more understanding of exactly how an underwriting process should be conducted. So it's really vetting the borrowers that are getting cash. It's not just throwing, cash out to any company that's starting up. So there's much more in the sense of the financial covenants that I mentioned, which give an early warning sign when a company might be going into a default scenario or performance isn't there. It actually gives banks an idea of, hey, what's to come. So that has gotten tighter for sure. And I also think that a lot of companies have now turned, to your point, Danny, to private credit funds rather than just, going with First Republic lines or SVB lines. And the last thing I'll say on that too is now SVB has actually come out with their own streamlined version of a credit agreement where it's pretty much a take it or leave it. So I think that that has been negotiated probably internally with their own in-house lawyers, and it's now created a much more uniform structure. But again, that has its pros and cons. Definitely pro for SVB because they know exactly what their borrowers will be signing up to, and it's much more uniform that way. A con being for the borrower where maybe it's a different kind of business or they're looking for more like a tailored suit rather than off the rack. So that's where the private credit funds really shine because they can do those things without having the red tape of what might be at larger banks.
Sounds good. Well, going back a little bit to your guys' firm, so LegalScale, you both previously worked at big law firms. So curious, maybe we'll start with you, Neil. You must have learned obviously tons working at a big firm. Now you're at a firm that you launched. Maybe start with, hey, what was it like working at the big firm? What are the benefits of working there earlier in your career? What do you learn there? What's the structure? And then a little bit of the story of what led you to start LegalScale.
Yeah, of course. And we really appreciate it. And first off, I'd say too, I think both Mehak and I were very advantaged to work at Davis Polk, and at the time that we did it, it was a Davis Polk is a large law firm based in New York. It has strengths really across all corporate practices. It also has a very strong litigation practice, and I think the reason that Mehak and I chose it was it was just an extremely congenial, like extremely helpful place to be. Every attorney that I met there, I had a great relationship with. And a key part of starting out and even starting out legal scale was having a great network of people that we could rely on. Um, not everybody gave us an enormous amount of business as soon as we came out of the gate, which is a fact of life.
Sure. Yeah.
I think that the truth of the matter is for us, both of us were advantaged by Davis Polk, but we did start to see, especially now that was coming on 10 years ago, at that point in time, revenue-based lending and some other items that Mehek was able to lean into, and for myself, secondary transactions where people were trading private equity stakes or trading the stakes of emerging growth companies. Those were really nascent, because of fees and fee rates as well as other items, Davis Polk wasn't perfectly set up to do that. And so Mehek and I started to think about, could we take a lot of what we learned from this terrific spot and then adapt it to um, something that maybe adapt this and build our own engine, but one that was maybe better suited for the clients that we were working with versus the Fortune 50. And so we started to do so, and thankfully we've had a lot of success so far. I think the other item that really advantaged us was I left Davis Polk first to start a private equity fund. And in addition to a very good return, the biggest thing for that fund was meeting 250 founders and funders in a non-legal capacity and hearing from them firsthand that their early stage funds weren't perfectly set up, or that they were getting sometimes the big law bait and switch of talking with a very senior person, but then working and having their drafting done by a very junior person that might not have understood the full feature set of what they were asking for. And so Mac and I, of course, knew that, but it was helpful to see those critiques firsthand. And then because I was no longer at Davis Polk and people had gotten to know me through this private equity firm called Faraday Partners, they started to reach out to me in a non-legal capacity just to take a look at documents. And then that grew into things that were much more legal in nature. And then I started LegalScale with the idea of being able to service these items. And so the combination of Davis Polk knowledge plus a network that was born of business practice was really the initial kindling that allowed that started the fire for LegalScale. And then once Mehak came on board, the rocket ship really took off. I was just putting two sticks together. So Mehak, I'll let you take it from there.
That's exactly right. And the goal is, to work with companies that I feel like we're making a difference in their company itself. So while it was fantastic to cut my teeth on larger facilities, I love putting a headline of I did an $8 billion facility for loan structure with multiple liens, first lien, second lien, third lien. Somehow those $8 million deals end up being much more difficult to do because everyone has stake in that outcome. So that's really what we really like doing, is working directly with founders and funders, whether it's on the lender side, borrower side, investor side, company side. We're able to really make a difference and help funds grow, help companies grow, and put more dollars out into the ecosystem, which is really growing. Even in the last 5 to 10 years, I would say it's really hit an S curve, like a hockey stick, in terms of just the growth of the overall economy itself.
Sound good. A little bit of a sidebar question, but I'm curious now, Neil. Like, were you nervous making the leap to launch your own firm? Is sort of the first part. What were some of the emotions of launching a firm on your own? And then if you were to sort of go time warp back to starting it, what is maybe a lesson or two that you would tell yourself?
Sure. I mean, you're of course nervous, and especially I think about it all the time, and especially when we're now just constantly hiring associates, and that's been great. But I think of those things of talking to those associates and making sure that they feel comfortable joining us is not unlike when Mehak and I first started our own firm. Because the opportunity cost is very much the same. Mehak and I were on this highway of knowing, sort of like just like seeing the mile markers on each road. We knew exactly how much money we were going to make this year. We knew exactly how much money we were going to make next year. We had great visibility for Davis Polk always doing these high profile deals and everything else. So there is a lot of trepidation when you're moving away from that. I think though that first off, the entrepreneurs and the dynamic managers that we work with, they exist in those same conditions of uncertainty. So it's hard to separate yourself from the environment that your clients are in. And that's where our clients live. That's where they're situated. And that's why they thrive, is because they're operating in these spaces that are new, just starting out, just scaling for the first time with increasing complexity or regulatory exposure. And so to be there is probably to be where you want to be. And frankly, as an attorney as well, if I'm feeling uncertain and my client's feeling uncertain, I'm going to have more calls with them and there's more for me to do and more for me to work on than if it's making small tweaks to language that we all know works in the first instance. And so there was trepidation, but things that were solvable and frankly exciting to do. Second, I had done this private equity business and I was thinking about going either back to a large law firm or doing this. And I found that I think that the combination of LegalScale was amazing. I think that both Mac and I like to have the business doctor's office of, somebody just called me just now and it's as though I can come in, I can, with a mission orientation, focus on a specific problem. I just got a text from a founder of an Internet of Things company that both Mehak and I have gotten to work with on the equity side as well as the debt side, just like Mehak spoke to for the other client. And I know exactly there's two problems, one of which is now mostly solved, but was not as of the end of the year. And then the second was a new debt facility that Mehak is working on that involves a warrant, and we're trying to make sure that warrant is not overly aggressive. And so we're constantly working on these items, and we get to come in and make sure that the capital that they're raising and the mission critical nature of raising that capital makes sense, that it can be deployed in ways that are prudent for the overall business. And so while I came in with some degree of uncertainty, what I knew was that I could marry these worlds that I really loved around finance and law with much more Main Street items of how do I raise the capital? I'm having problems with this employee. And when you get that holistic sense of what a client needs and what they're working on and their day to day, one, they become not just clients, but trusted friends. And we're lucky to have had friends now for over a decade here. But then second, I know what I'm doing is really impactful for these businesses and it helps me stay at the extra hour in order to make that impact.
Well, I'll sort of wrap up with just a couple other questions. Neil, at the beginning, you mentioned a little bit about new emerging managers, how you're guiding them, and sort of one of the pieces of advice that I agree from my side too, that we try to encourage is simplicity. What are, maybe from both of you, maybe Neil first, what's one other mistake that you try to guide new fund launch emerging managers, sort of a mistake you see them make that you try to advise them out of?
I think the biggest item is really just investor expectations, including for return expectations. And so managers want to bring in, and justifiably, of course, every dollar, and they want to do so in order to proceed with the investment. That's obviously very important. And capital raising comes with the nature of making promises and then delivering against the promises that have been made. What I would say though is there are times at which, if you're starting Mac and I work on a lot of private debt funds, for example, the return profile of those funds is very different in terms of both the maximum level of return possible, as well as the dispersion of potential returns than the venture firms that we work with. And those venture firms as well, if they're investing in growth rounds versus seed rounds, those have very different return profiles as well as timing. So so even if the fund documents look the same and I'm doing a venture fund, that will often have a 10-year period with two options to lengthen for 1 year at the discretion of the manager. So a maximum of 12 years, and that's pretty common. But the truth of the matter is the late stage growth fund could be distributing its Anthropic stock 2 years from now, whereas a company is making a Series C round, if they're making distributions in 2 years, that's going to be either a crazy outcome or maybe a problem because the company just doesn't have the prospects in order to remain within the fund. And so what I really just encourage investors to do is to be honest, right? To talk about, here's what we're modeling for, here's what success looks like. here's the bull case outcome, here's the base outcome, here's the bear case outcome. And if a realistic set of conversations with investors will be so helpful in order to make sure that you're not relying on legal or anything else down the road because investors want to run for the exits because now we're in the midst of the J curve. And that's a totally normal part of investing, especially in early stage venture investing, but one that is often much more borne by a mismatch of capital expectation versus the investments that the fund was making than anything else. And so to find what Warren Buffett says, and it is definitely true, is to get the rock fans to the rock concert, not the ballet fans, right? So because if you have the ballet fans to the rock concert, from the time that they first hit that first strum, it's going to be a problem. Let's just find the exact right sources of capital, the right market segment for your fund so that it's off to the races.
Yeah, and I agree with that. And to add a little bit more is when, let's say they're setting up their first fund, they're overly customizing things where they haven't tried it out yet. And so usually what we encourage is, there's a reason why the chocolate chip cookies the most liked flavor out of all cookies. Is because it's tried and true, right? And so when we're setting up the first fund, let's try to look at what's been done, what would work within your investor pool and for the type of investment you're making. And then as long as that continues to work, let's then try to customize the next one and make it more bespoke to exactly what you're looking for. And maybe that's a single asset SPV instead of a full on fund, and we can be more creative there. But there's always an idea of let's make it super, super complicated to start with. And then a month later, I'm on the phone again to be like, how does this work again? Because no one quite understands what kind of camel we ended up making. So that's another thing that I've noticed where maybe it might be easier to go with the chocolate chip cookie rather than the rainbow sprinkle unicorn cookie from the get-go.
That's great. Well, you guys are awesome. What other advice might you give maybe folks sort of stepping to the other side away from like the investors and your clients, but folks maybe earlier in their career, maybe they work in big law thinking about going smaller, maybe they're in-house and on the other side of the table from you guys working with lawyers assisting. Any other general advice for folks earlier in their career that you would give?
Yeah, I mean, I think that there's one piece of advice that I think applies broadly, which is one, maintain great people within your network. So the way that Mehak and I met Danny, for example, is that Danny was at one great fund admin and is now at an amazing one, IQ EQ, that we recommend to a large number of our clients. And I think that we know service providers, we know other peers within our space that are great attorneys, and then we know, and as I spoke to before, we know a lot of entrepreneurs that are either starting in the process of scaling or selling their businesses, all of which that we can help with. And so I think especially for us as a service provider and quarterback in a lot of deals that we're running, there's an enormous number of times that a dynamic manager doesn't even know what a fund admin is, let alone what they should do and how they should be engaged. And so to be able to then just to loop in Danny to those conversations is incredibly accretive. It's really great. And so I would just build a network early, never burn a bridge, and just keep those relationships going over time. I owe Danny a stake at some point coming up in the next few months, and we'll go from there. And I think that really is the goal seek for us is to maintain and to nurture a great network.
That's 100% right. What I also like to mention is that a lot of my credit documents, for example, I call them living documents because unlike, let's say, an M&A transaction where everything kind of ends once that acquisition is actually completed, these fund documents, these credit documents, it's an ongoing relationship. So to Neil's point, you don't want to burn any bridges, but also you don't want to engage into point scoring, which is what we call when people are just trying to push their points for the sake of pushing their points, but it's nothing that's actually critical to a transaction. Is in fact something that's holding up the transaction from getting done. So to have a mindset of I'm not working against you, I'm working with you is a great way to approach all of the transactions you're working on because that will not only allow you to work more amicably with everybody, but also to finally get the deal done, which is the most important thing at the end of the day.
Right. The reputation that's most important is just generally being good, having the work be done right, and having the work be done on time. And however many points it takes to score that isn't actually the measuring stick, right? It's like build a reputation of getting it right and getting it done on time.
Exactly. And, a lot of our clients will treat time as another way to measure their cost of capital. the longer it takes to get a deal done, the more expensive it ends up being, not only on the fee side, but on opportunity cost. So it's important to keep that in mind.
Awesome. Well, thank you both for being on here. This was great. We'll have to have you back on time or back for another time. I'm sure we could do a whole series of sessions with you guys. So thanks a ton, and I really appreciate it.
Danny, this has been
Yeah,
great.
thank you.
Thank you.
Thank you for having us.